I'm the head of strategy at Intellidex. Today, we have a very special panel discussion on one of our most recent reports called Investing for Impact. We're glad you could join us for this deep dive with our panel of experts. The report is based on a survey of South African pension funds, and our aim was to collate their views on investing for impact. In the report, we also contextualize the research goals and results within wider debates regarding investing and how social impact should be considered. The report was developed with the support of Ashburton Investments. We would also like to thank Anne-Marie Dalton, CEO of Batseta, the Council of Retirement Funds in South Africa, for calling on members to complete the survey, as well as ASISA, which is the Association for Savings and Investment South Africa, for help with developing the research questions. And finally, a big thank you to Alan Greenlow, the publisher of Today's Trustee, for encouraging respondents to participate in the study. I would like to introduce our panelists in just a minute, but just let me get through some housekeeping rules quickly. And this is really a way for you to participate in the discussion today. Please feel free to ask questions. You should see at the bottom of your screen, there is a panel and there's a QA function. If you have a question for the panelists, please type it in there and then we'll pose those questions on your behalf to the panelists. We're aiming to finish the conversation in about an hour, so it'll be my job to keep us on track for that. Let me now allow our panelists to introduce themselves. Let's start with Malcolm.
Malcolm is on mute.
Sorry for that.
There you go. Hi, Malcolm.
I was talking. I figured that actually someone else had muted me because I wasn't on mute earlier. So let's try that again. Okay, so hello everyone. I'm Malcolm Fair. I'm the managing director of Rescura. Rescura is a purpose-driven firm of investment experts. We offer a range of services across the investment industry, and in this context are best known for being a prominent investment consultant in South Africa. Also one that cares not only about the money and the numbers, the returns, but also about the lives and futures of the people who are impacted by the investments that clients make. This is a topic that I'm particularly passionate about, so it's great to be on this panel today and participate.
Thank you, Malcolm. Heather Jackson joins us from Cape Town. Hi, Heather.
Hi, Grant, and welcome everybody, and great to be amongst this illustrious panel. We've all in one way or another helped to shape this report. So I head up impact investing at Ashburton Investments, but I'm a long time trench sitter in the space of impact investing. I started focusing in this area back in 2007, building up teams and funds and really specializing in what I think is one of the most interesting areas of impact investing, which is working across private, public and NGO sectors in collaboration through what we call now blended finance vehicles to create solutions, really bespoke solutions to many of our social and environmental challenges. And the other interesting thing looking across this group of panelists is that we've worked together in different iterations of our careers with Malcolm and with Mabatu. So yeah, really great to be amongst you, and thank you to all the participants dialing in.
Thank you, Heather. Once again, thank you for joining us. Next, I'd like Jolly Mokorosi to introduce herself, please.
Good afternoon, everyone. Good morning to you, Grant, and the guys on the other side of the world. So first of all, I just want to say congratulations on your study. For me, this kind of fills a hole that we have in terms of data around African countries, and particularly for us in the retirement fund industry. I'm quite appreciative of that. So when I was thinking about it today, I thought about how, you know, impact, climate change, and sustainabilities are just, these are just a few subjects that are so topical and kind of, unfortunately, something that's become nearly like a flavor of the month in some, and is in a sense losing its essence if we really think about it. So I had to kind of dial back a little bit when I was thinking about today, and I just had this thought that if we, you know, I've always certainly been somebody who's worried about certain things. And if I think about my childhood, if I think about when I was growing up, I used to hate the month of August. And one of the things I hated about August is that it rained all the time. But now I'm sitting in Johannesburg and it is September and we have not had rains. And this is just an indication to everybody just what climate change is actually doing on just a personal level. People are denialists in some spaces, but the one thing I can't deny is that it rained throughout August when I was growing up, and it's not raining anymore. So if I look at it from a professional perspective, I work with farmers. So what does that do to their crops? It means their crops fail. What does that do to crop insurance? It means that crop insurance either goes up or the companies providing crop insurance then fail. What does that do to institutional investments? It means that we are losing that business as a possibility for us to invest in as institutional investors. And that is reducing our diversity. Or what does it do to me as an individual? It means that I am going to start experiencing issues around food security. And as I had this series of thoughts, I thought there is no denying that things like climate change, sustainability are important for me as a human being, as a person. And then if I look at it from another perspective, how about the way when I drive to Durban, there's one road which I will take to drive from Johannesburg to Durban. I will take the N3 to drive from Johannesburg to Durban because that is the most convenient road. I don't care if it's a tolled road, that is the most convenient road. And I don't know anybody who actually takes, not even the taxis use the alternative routes because they're just not, they just don't make sense. So people forget that the N3 was built through pension fund money. That is what impact looks like in our daily lives on a kind of a practical level, that I can use this road. So if I, as an investor, I'm thinking about, am I going to invest in the N3, which actually makes sense for me, or would I rather put the money in say, a fast fashion business? I, as an institutional investor, am more likely to lean towards the N3 investment than the fast fashion business. And in addition to that, I'm also more likely to lean towards something that makes long-term sense for me. So impact investment, just as an African, as an institutional investor, as a retirement fund, will always make sense to me. But I think where things become tricky is that we often try and suspend investment, governance, and general good principles of business in the name of impact investment, which is incorrect. It needs to go through all of those. And I think if there's one thing that I want to kind of pass on as a message today, it would certainly be around that area. And that for me is a very long introduction to me.
But now at least we know where you're located and where your heart and mind is at. So thank you, Jolly. Thank you for joining us. Lovely to have you in the discussion today. Let me now turn our attention to Mabato Seiso. Mabato, hello.
Hi, Grant. Good afternoon, everyone. It's a pleasure to be part of this panel. I think what we all share in common is our passion around impact investing. My private, which is not going to be such a private ambition anymore, is that I can drive as many of my pension funds as possible to invest in impact investing. I serve as an independent trustee, and I also serve as an independent chair of a number of pension funds. I consider myself lucky enough to have just recently joined the Eskom Pension and Provident Fund because they are at the forefront of investing in alternatives, and a significant part of that is impact investing. I also chair two impact investing vehicles. One is the Truck Stop Investments that was initiated by the Transport Sector Retirement Fund, and the other one is the Sakolo Housing Fund, Affordable Housing Fund, which looks at developing affordable housing. So I'm excited to be here to contribute to the discussion.
We're about to welcome, and we're so grateful for your time. Thank you so much. And on to our final panelist who joined us from London, Stuart, hello. Stuart, I think you're on mute. Yeah, there you are.
Apologies. Thanks, everybody, and thanks to everyone on the panel. It's a really esteemed group to be joining. I think, you know, our objective, our mission, if you like, as a company is to see how we can facilitate financial markets to be used as a tool of development. So that means Intellidex, which is a research-led consulting house, sort of spans what's come to be called the spectrum of capital. So at one end, we work with global asset managers and hedge funds on investing strategies involving Africa. And on the other end, we work with foundations and philanthropies on developing different ways to access financial markets. So, and everything in between. And of course, impact investing has become a very important theme that we've worked quite hard on various aspects, ranging from developing concepts for sovereign issuance through to concepts for driving youth employment, for example. So we're very engaged in developing how financial markets can use impact investing tools and how agents of change can access them to advance their work. So that's our point of departure, and this project was a really exciting area to work in to really access pension fund views on how they see impact investing, and I think the results have been super interesting. So good to join you all.
Stuart, thank you. Thank you again for joining the panel and for your hard work producing the report, of course. So thank you very much. Let me start. My first question I'd like to pose to Heather. Heather, before we get into some of the findings and the details of the report, please tell us why Ashburton commissioned this research and why you felt it was important that this work gets done and that the message gets into the South African discourse at the moment.
Yeah, so it's a kind of a multifaceted answer, really. You know, a number of us we have our day jobs, but then we're also involved in a number of you know, industry bodies, advocacy groups, and so impact is quite unusual in that way, in that, you know, people talk to each other. They're competitive in one sense, but actually very collaborative around trying to promote this passion that everyone clearly shares around impact investing. And for us, we actually deliberately, through our partnership with National Treasury's Jobs Fund program, have an advocacy component that we need to deliver on. And so we're in the fortunate position where we could kind of scout the landscape and say, where did we think we could actually invest to make a difference and kind of move the needle on impact investing. And one area that we felt quite strongly was lacking was a kind of independent, fresh perspective on what investors' views towards impact investing were, what their perceptions were, whether they thought there were gaps or constraints in the advancement of impact investing. But it was important that it was independent. So fortunately, we were able to commission this and fund it. But you know, we're thrilled with the outcome and the inputs and the commitment from so many people to shine a light on this impact investing space. So, you know, that's been really important to us. It also had the context of, well, quite a favorable tailwind, if you like, when we actually, and it's been quite a long process, but when we did commission Intellidex, the FSCA had just issued their guidance note in response to the sustainability issues coming out of Reg 28 reforms many years ago. And we felt as an industry quite strongly that the industry lacked real guidance and also reporting requirements. And so that's what the guidance note has provided to industry. But again, it just hangs there. And so we feel that this report also helps to kind of pull together what pension funds are thinking and what kind of responses are likely. And so, yeah, the hope is, of course, we didn't anticipate we would be in the COVID environment as this report was released. And of course, as we know, COVID has just magnified all the ills, all the challenges, both socially, environmentally, and governance-wise that we face. And so, yeah, just really a very timely document. And I hope it, it serves to gather momentum the way we know we need in this space. So thank you.
And thank you, Heather, and thanks for that introduction and broad overview. Allow me quickly to just give our members of the attendees a little bit of background on the survey and what the results are that we are seeing in the report. So we had 49 respondents answering the questionnaire, and we ran the research between about the beginning of August and a little bit into December of last year. So all of this work, as Heather's already pointed out, was done pre-COVID. And what we were able to collect was data from, at least assets under management data from 47 of the 49 funds, which we tabulated at 2.6 trillion, or about 65% of the industry's assets under management. Now, that's quite a significant coverage for such a small number of pension funds, but we do know that there's a large number of assets that reside with a smaller number of funds, and that's why when you do a survey like this, you can reach quite high coverage in the industry with a small number of funds like these. Secondly, our intention was to understand from our respondents where they were located and what their functions were in the funds. And primarily, our objective was to speak to principal officers, but also obviously we had feedback from trustees, from pension fund managers, from ESG or sustainable investing consultants in the funds themselves. And then we had another category for people who didn't fit any of those four profiles. But the majority of the respondents in the study were principal officers of the pension funds. Secondly, in terms of just a profile of the respondents, we have covered about just under 4 million pension fund beneficiaries in this research. There's about 16 million in the country, so this represents probably about a quarter of the people that are invested in pension funds in South Africa. And then finally, just a brief profile on, again, about the funds that did respond. 50% of them were pension funds, 30% were provident funds, and then the final 20% were a mix of pension and provident fund combined. Let's move on to the next slide, please. Thank you. So here is the first place that I would like to start. And the issue of terminology and naming and classification and language came up so strongly in the research that I thought we should start by just discussing some of these concepts that we see on the slide in front of us here. So for example, we picked up a set of definitions from the Global Sustainable Investment Alliance, but that didn't match exactly the language that we found in the G8 Social Impact Task Force. And then of course, there was a whole range of other international bodies and so on that are trying to clarify the space and working on structuring our definitions, our understanding. Similarly, in South Africa, we've got Regulation 28 and then specifically Guidance Notice 1 of 2019. And those were only some of the attempts that we found in doing the research for giving us a language in which to work, now to make sense of this new field. So let me start with a question to Stuart. Stuart, you were the lead on this research project and you chose the title Investing for Impact. Can you tell us why you chose that title?
I can't take all the credit. I think that was a collaborative outcome. I certainly think at least Heather had a hand in that title. You're right that the terminology here, the conceptual groundwork is pretty messy. We have different standards, different languages, depending on who's talking. Impact investing itself means different things to different people, and we wanted to distance ourselves from the controversy to try and come up with something that reflects a broad trend that we wanted to capture. A broad trend that moves from traditional investing that you've got on your side on the left and along a kind of graduated framework that moves towards greater social impact, starting, I guess, ESG as a much more common framework used in the institutional investment market. So investing for impact was just a way to capture all of that terminological spread and give us a general term that reflects the idea that we're going beyond just traditional investing into different forms of investment strategy that reflect some recognition of social impact or social issues in an investment decision framework. So that was the title. It was to try and be non-specific.
Thanks, Stuart. Malcolm, in our conversation in the work to prepare for this report, I found your commentary about the terminology also very interesting. Would you care to share with us some of your impressions about the terminology and the language that we find in this space?
Sure, Grant. I'm not sure I can remember exactly what we discussed, but I'll have a crack at it. I find the terminology has been an interesting journey for me. When I started in this space, I was in an asset management firm in the late 90s in South Africa that ultimately became Future Growth. And and back then, this space was occupied by the terminology socially responsible investment, which you have in that spectrum of capital on the screen there. But it's evolved. So and actually, it's evolved in pockets around the world. So different parts of the world like to use certain terminologies. And for a long time, I was quite stuck on the fact that we need to get a common terminology, and I think I wasted quite a lot of energy trying to get that right. Eventually, I let that go, and I watch with interest as the naming process and terminology changes. I was noticing the other day the trend in ESG, for example, where it started from being I'm incorporating environmental, social, and governance factors into my investment decision-making process. Then it became I'm integrating ESG in my portfolio, which doesn't quite work with the English. And recently I heard someone saying, I'm going to be ESG-ing my portfolio. So it's now become a verb. And so I think, there's kind of these evolutions, and I watch with amusement as they happen. So, is it important for South Africa to have common definitions? Yes, it is. And for me, I'm quite analytical. So I come from the angle that measurement is quite important. And because you can't, what do they say? You can't manage what you can't measure. And I think that's actually having visibility in portfolios, and this ties nicely to some findings later in the report around transparency was, if you want transparency, if you want to know what you're actually doing in this space, if you want to be able to say, hey, 3% of my portfolio is in directly impactful investments, or 20% of my portfolio is in companies with environmental issues, for example, then you do need to measure. And for measurement, you do need definition because you need to know what's in and what's out. So I think definition is important. The other part of the question here, is it important for South Africa to align with the rest of the world? Well, to the extent that you want to report on the same things and have comparable statistics to what the world's reporting on, yes. And again, for measurement and comparability, then you do. From a perspective of South Africa, here I feel like there are some issues, let's call them, in South Africa, which are fairly unique to our country and which may not actually be big issues or even be incorporated under such a definition or umbrella outside of South Africa. And I feel like that's a bit of a loss if we were to be dogmatic about a particular definition, at the loss of incorporating a broader church within South Africa and actually having the impact have as much reach as possible. I think that would be a loss for us. So I feel like, we need to be a little bit flexible. We need to do things that are right for South Africa, but it would be good to have them have the definitions such that they could be compared with our global counterparts.
Thank you, Malcolm. I'd like to get our two panelists who are actually in the pension funds to give us a view on their experience of language and where there have either been challenges around language and terminology and definitions and where we've had the chance to, or at least where there's been progress made. So let me start with Mabatu first. Mabatu, please share your experience on this topic with us from where your perspective on the boards and as a board of trustee.
Yeah, so I don't think necessarily that we paid a lot of attention on language when it comes to this. I can only tell you what a lot of the time you hear when you're on the pension fund board. You hear ESG. I think every single fund now integrates, because as part of Regulation 28, you must integrate ESG in how you look at investments. So it's now become a norm. So everybody understands ESG. Now, in terms of the differentiation that I see here, you don't see it. So people will understand about ESG. For now, and I think it talks to what has been important in the South African context when it is the E, S, and G. I think what's come out is that impact investing is a big thing. So now you're hearing what is very topical among members, and certainly in pension funds, is issues around impact investing. We have not gone as far as you have, and I think this has been a very important differentiation of the different pockets that make up investing for impact. So I could pretty much say that it's an educational thing for us. We haven't really defined it in the way that you have. So now we understand what the spectrum looks like.
Wonderful. Well, I'm glad to hear that we're going to have some potential way of helping the funds think about where the various strategies and how they might work, and how the sort of spectrum, what the spectrum looks like and the opportunities look like. Johnny, from your perspective, do you find it similar to Mabatu's experience? I know that you also work in trustee education, so please share some of your thoughts on this as well.
So from a trustee education perspective, the more aligned we can get definitions, the easier it is to actually put a concept across. Because if things are nebulous, then you get the one asset consultant speaking about the one thing and another one speaking about another thing, and trustees are not sure if these two things are the same. So the closer we have to a taxonomy in the different categories of investments, and the closer we are to speaking the same language, then we can align kind of what we're doing better across different funds. Now, having said that, you must also remember that retirement funds do not operate in a vacuum. They actually operate in an economy that is political. We do have influences that are outside of financial services. And when we have one definition that aligns, then people who we interact with that have an impact on how we do things outside of our industry, then are on the same page as us. I will allude to the manifesto of a large political party that was released last year. And in that manifesto, there were issues with some of the terminology. Their understanding of certain terminology was different from our understanding of the terminology. And the horse had kind of bolted by the time that was printed. So there needed to be an alignment post some of the political utterances that were made to say that, no, your understanding and our understanding of these two things, we call them very different things. So we don't operate in a vacuum, whether it's with trustees or even with members, because with members as well, if they hear that you are taking investments and they don't have an understanding of what social investments are versus socially desirable investments versus CSI in a company, then they think that what you're doing is effectively charity work with their money. They don't think you're making an investment decision. So that's why definition and words are so important, because you can have the wrong kind of outcome for what you're trying to do. Having been involved with a retirement fund that had put members' money, it didn't put members' money into May's futures, but I can tell you that some members 10 years down the line were still saying, you lost my money in millies, just the understanding and the concept, it just needs to be aligned, because once you send out the wrong messaging, then it's very difficult to retract that, particularly on the larger funds.
Thank you, Jolly. Thank you very much. Very insightful. Before we move into more of the findings, there's just one of the debates that we were able to pick up in the research was clearly there's a huge momentum globally towards investing for impact. And the numbers that get released on a sort of biannual basis seem to continuously be climbing. And we're actually having our conversation with the backdrop of the Global Impact Summit, which is taking place online. It was meant to be in South Africa this year. But again, we're starting to hear in that conference that there is a forward momentum on the number of funds and the value of investments that are now in the category of investing for impact broadly across these multiple strategies. But it's not as cut and dry as that. We did also, in our research for this report, pick up a number of dissenting voices who feel that what we're doing here in this space is not exactly in the interests of pension fund beneficiaries. And they raise the debate around the fiduciary duties of the trustees. So I'd like to pick up on that question. And if I can start with Mabatu first. Mabatu, what is your view on these dissenting voices and the debate on what the fiduciary duties of the trustee actually are and what they are not, and how they are shifting as we're considering investing for impact?
So thanks, Grant. So the way I understand my fiduciary duty as a trustee is simply to act in the best interest of my members. So what does that mean? It means making sure that there's good governance on the fund. It means ensuring that the assets of the pension fund assets of my members are safeguarded. After all, very often these are the only savings that most members do have. And thirdly, it means I have a liability or a promise to my members that when they retire, there is a certain amount or a meaningful retirement that I promised them. And therefore, I have a responsibility to grow their money at a certain level. Hence, we have benchmarks on our funds. So let's go back to when I say act in the best interest of members, what do I mean? And I don't think you can define that without taking on board the word of your members. The days of having a very paternalistic way of investing, I think, are long gone. I think we also need to respect the word of members. And what are a significant portion of my members saying? They're saying to me, for me, meaningful impact is when you look at investments from three angles, no longer just risk and return, but risk, return, and impact. So it's become, there's a shift that they want us to do from how we see investments as fiduciaries to what they think it should be. That's the one thing. But secondly, if you say as a fiduciary, and I think it comes across a lot in your report around the importance of risk management. So this is what I say to people. In an environment like this, where there's a lot of volatility, surely one of the things that you need to be looking at is diversification, having assets that are uncorrelated to what you hold. It all therefore means that you need to be looking at the whole investable universe, including investing for impact instruments. You know, in other words, what I'm saying is good ideas that will generate returns for you are not always on the listed market. So I think it's being a good fiduciary in a fund to look at opportunities that will enhance your portfolio, that will enhance your strategy. So things that will bring diversification, lower volatility, etc. So my sense is that a lot of people who say it's not part of their fiduciary duties, I think partly is an ignorance of the space. Also because investing for impact doesn't also mean that it's, you're investing in things that are unlisted. Sometimes like we have green bonds that have been listed. So I think there's a lot of confusion around this space, and hence why I think having a report of this nature goes along some ways in terms of helping people really begin to understand what this is about. In fact, I think it's not being a good fiduciary when you ignore this whole investable universe that actually in many instances have shown that it can produce returns and bring you the risk reduction that you need in your portfolio.
Mabatu, thank you very much. I think that's an interesting perspective. I'd like to hear Malcolm's views on this particular question as well. Malcolm, can you share some of your thoughts?
Yeah, three quick thoughts on this. I'm totally with Mabato on this and what fiduciary duty entails. What I would add actually is that in essence, that duty to members retiring with dignity, let's call it that. Not only does the member need the money, but what actually is also true is that there's no point retiring with a pile of cash if the environment and the society into which you retire doesn't exist. So you kind of grow this big pool of money, but if you get there and there's rioting on the streets and there are no roads and the environment is trashed, you know, that's not going to be a very pleasant retirement either. So actually the fiduciary duty to some extent extends to beyond just the pile of money you're trying to amass. The second thing is that returns are not compromised, and there's a lot of academic research, a lot of meta studies that have been done now. So one I looked at the other day, over 2,200 studies were looked at, and 90% of them said returns were either better when you incorporate ESG and do impact, or they weren't any different. That's a huge body of evidence in favor of this. So really, I think that's an excuse. And the last thing is that what we probably will enter into shortly, globally and potentially in South Africa down the line, is legal liability for not incorporating these. And that's actually why the guidance note came out last year from the regulator, to protect trustees. Because if you think about climate change, for example, what's very possible is that future members of pension funds sue boards of trustees for what they didn't do in the past to protect them from the effects of climate change now in the present, winding forward 30, 40 years. And actually, that's a major issue. So the legal implications are coming for not doing this. And actually, I think, you know, people need to realize that.
Wow, thank you. I didn't even know that, Malcolm. That is fascinating.
Yeah.
Let me allow Stuart to jump in as well, who also I think wants to share some thoughts on this particular question. Stuart, over to you.
Thanks. I think this is a really interesting debate. So I hear Malcolm's point on ESG not compromising returns, but I've been pondering this a lot, and in some of our work on sovereign social bonds, for instance, the question is always, is there some break through the yield curve that they can benefit from, either in issuing green or social bonds compared to their vanilla bonds, right? So there the debate is, am I as a government getting some kind of discounted cost of capital because I'm doing a green bond instead of a vanilla bond? And one would think that in driving impact demand at the final investor, you're shifting demand curves for impact assets, which should mean that the investor is willing to give up some yield in order to gain some social return, call it that. So we might think, just as a matter of logic, that as ESG or impact assets become more popular, more in demand, there will be more bidding for those assets and therefore yields will fall. But of course, the kind of investor, the cynic in me goes, well, you know, if yields are falling, we're opening up an arbitrage opportunity for everyone to come in, all those nasty hedge funds to go short impact investing and long oil and coal assets and open a risk-free arbitrage for themselves there, right? They can sell green bonds and buy dirty oil bonds and get a high yield for free. So the arbitrage effect is going to force out the demand effect of greater demand for ESG assets. And so as a result, governments and other issuers of social bonds are not going to be getting a yield benefit. If anything, the demand factor is shifting yield out of the hands of impact beneficiaries into the hands of evil oil hedge funds, let's say. Okay. So that leads me to the thought that as we develop the impact investing marketplace and concept, that the demand, the economics of this really have to happen at the instrument yield level. And what do I mean by that? It means that we have to ensure that the oil asset has a yield that is comparable to the green asset because of the profits that each of these two underlying investments actually make. Now, a policy intervention like a carbon tax, for instance, lowers the profits so that way you're lowering the yield and you're not through arbitrage transferring wealth from green investors to oil hedge funds, which you would be doing just on the demand factors on their own. So, and part of the impetus for this project, as Heather mentioned, was the FSCA's guidance note on getting pension funds to be more transparent about ESG factors, which transparency means allowing pension ultimate members to understand what their funds are doing and to exercise what choice they can in guiding the behavior of their funds in their interests. So we're trying to get the demand side to work to drive institutional investors more into ESG assets. But I wonder about the arbitrage, and I wonder about whether our policy attention shouldn't be more focused on improving the underlying returns of ESG assets compared to non-ESG assets, rather than trying to do it at the demand side of investor appetite. And I'd be super keen to hear people's thoughts on that.
Fascinating, Stuart. We started this discussion yesterday as we were listening to some of the presenters in the forum at Impact Investment Summit. So I'm glad that you shared that, because I was actually going to ask you to tell us a little bit about what your perceptions were of some of these ideas from the conference yesterday. Let me get Jolly to respond. Or Jolly, you have another point to make on exactly this question?
I just wanted to support what Malcolm is saying and just say that some of these, this shareholder activism has already actually started happening. For those of us who do sit on those unionized funds, the one thing that has come through very clearly from them has been a shareholder activism, in the sense that they're asking, how is this investment that you're making as a retirement fund benefiting the labor sending areas? I mean, this is something you cannot run away from in South Africa, that politically we were structured in a very artificial geographical manner. And so was the investment. The investment followed that. And those labor sending areas do not have the necessary levels of investment to even call ourselves a second world, let alone we're a third world country in those, when you just look at the service delivery in those areas. So members are asking us as retirement fund trustees, show me how my money is making the place that I come from better, or the place that I am retiring. So I think at this stage it's probably not formalized in some instances to the extent where we're going to court, but it's certainly as a trustee something that we are being asked by our constituencies, by our stakeholders, by our members. Where are you putting my money and why are you putting it? We are slowly seeing that members are against us using their money to increase these bigger, more fancy, glossier malls and places. And more they're saying, no, you got to use my money in a way that benefits me and my long-term future, not just somebody's aspirations and dreams. Yeah, and I think, Stuart, what you're saying is interesting as well. But does it take into account, if I can turn around the question and say, does it take into account that some of these resources that we are shorting from a business perspective are running out? So, I mean, look at mining. Mining was huge in South Africa, but now coal is like hen's teeth. You know, we are paying more and more for something that seemed abundant. So yes, there's the instrument behind it, and there is the technicalities and everything, but there is the hard reality that on the ground as a business, that resource is actually running out. Whether it's coal, whether it's water, or yes, it's dirty, but it is running out.
Jolly, thank you very much. And Stuart, I'm going to ask that you not respond to that right away. I'd like to move our discussion forward, but I think Heather has a point to make about this question as well. And then once Heather is done, folks, we'll take a look at some of the results in the survey. Heather, over to you.
Thanks, Grant. Sorry, I know we are belaboring this, but I think it's a really important and interesting
discussion. Very important, Heather. Yeah.
Just to respond to Stuart, so I'm probably not such a sort of adherent of efficient markets, clearing in quite the same way. And I think often what's really interesting in the impact investing space is how neglected it is, and how there's not necessarily efficient clearing of markets, and you have pockets for whatever reason, vested interests or regulatory reasons or historic legacy reasons, which are largely ignored by the markets, and yet they offer good investable opportunities. I mean, infrastructure is one such case, which is very complex to fund into, and there are lots of reasons for that, but it invites creative thinking, and it invites ways to figure out how you break some of the log jams, how you participate across municipal and private sectors such that you optimize both role functions, for example. But in particular, as impact investors and your sort of evil oil traders versus the greenies, what we find is that there are many disintermediators who come into the market who say the traditional suppliers of capital, the banks or whatever, are not actually doing a meaningful and efficient job at providing goods and services to relatively neglected sectors or segments of our population. And so they actually spot genuine market opportunities. Yes, it might be to collectively poor people, but that doesn't mean that they're not a strong customer base if the intervention, if the funding mechanism or vehicle is actually done correctly, and servicing a real need with all the kind of safety checks and balances in place. What I think there is very often, which invites opportunity to invest, is a misplaced risk perception that just because you're funding into refurbishing inner city slums, that necessarily is a poor investment proposition. And I think there are many, many examples like that, as well as drawing in concessional funding because you're aligned to SDGs or to development finance institutions. And so you can, again, through more creative application of solutions, actually use superior risk-adjusted returns, which is perhaps feeding back into the kind of surveys that Malcolm alludes to. So just a quick comment around that. Thanks.
Thank you, Heather. Yes, I'm glad that we are spending as much time as we are talking about this topic, because it does seem to be sort of the underlying issue that seems to get us stuck when we start to get into this conversation. There's this fundamental core debate about what the duties of the trustees or the fiduciary duties of the trustees are. And if we're not able to bridge that and to bring that debate into the open and be more mindful of where the constraints are, we potentially don't have an ability to move forward in this space, or we may be particularly biased in ourselves with particular preconceptions and preconditions ourselves for a desire to see impact, and we may not be conscious of potential dissenting voices. So I do think it's always important to bring all of those voices into the conversation. So panel, thank you very much for that engaging discussion on that particular question about fiduciary duties. I'd like us to have a bit of a conversation now about some of the results that we're finding in the survey. The first one is clearly that if you look at the slide on the graphic on the left-hand side there, the question was, how do folks, the respondents, see the role of sustainable investments in the next 5 years? And just a quick point on methodology in terms of how we calculated these results. There's weighted and unweighted results, which is why you see the two circles represented there. Unweighted results are a pure count of number of responses. Weighted results take into account the respondents' assets under management. So we've weighted heavier the funds with bigger assets under management. And so you always see this split in the results as well. And we think it's important to highlight that difference, because you also get a sense of the different perceptions and perspectives or expectations or knowledge, etc., from your smaller funds versus your bigger funds. And I think this is also a very interesting dynamic that we see in the results. Now, that first answer there about the role of sustainable investments in the next 5 years, it really took me by surprise when we were looking at these numbers. We're almost at 100% on the weighted results, call it 98% to be precise, that respondents are expecting sustainable investments to be much more important in the next 5 years. Similarly, when we looked at studies that didn't include South Africa, but did a more global sweep of the other big pension markets, the North America, Europe, Asia, Australia, etc., we found studies that indicated to us that a similar question was asked, and only about 75% of the funds in those responses indicated that they're expecting sustainable investments to be a bigger issue in the next 5 years. So Heather, while you are warm and on the mic, why do you think this is? Because this is also a result that struck you in the discussion on this particular study.
Very much so, and I think for all of us involved in the space, it's enormously encouraging result. I think probably two factors at play here: one kind of carrot and one stick, push and pull factors. I think it would be it would be surprising and a little disappointing if we didn't, as a community, as the South African pension fund industry, feature the importance of impact investing so strongly going forward. We sit with, across ES and G, we sit with some of the worst statistics in terms of inequality, of unemployment, even in health and access to health and education. We don't stack up very well relative to our peers. So clearly huge challenges to overcome there. And as we know, they're just exacerbated now. Environmentally as well, Southern Africa is an enormously water scarce area. We have a reliance on fossil fuels. We have huge environmental challenges as well that we need to overcome. And then of course we know how governance issues and corruption plague us. So I think that there's a real sense of urgency that is playing through in these kinds of responses. And I think what's encouraging is definitely a demand for more impact solutions. So that's a strong message to all of us, which we can take to heart. I think there's also something else at play here, which is from time to time, the sort of ugly head of, depending on where you're coming from, but certainly for us, the ugly head of prescribed assets comes into focus. And that's probably also a consideration driving this. But interestingly, I would say, and it was certainly a theme that came through in your report, that responses like that surely say, do we really need prescribed assets? If there's a genuine demand out there, we need to service that demand, surely. We don't need to bring out the stick just yet. So I think, those are sort of some of the push-pull factors. And then also, I think, interestingly, just as a society, we've just seen our the largest opposition party release its policy statement, and very much aligned to the SDGs, which hasn't been reported that much in the press. But that's a very interesting development. We know that the governing party, the ANC, has developed the National Development Plan and goals, also aligned to the SDGs, although some hit and miss in terms of actually genuinely integrating that into policy and practice. But that is the backdrop, the context that we have, and so I think it's very powerful but very encouraging to see that result.
Interesting. Heather, thank you. I want to ask Mabatu for her views on the panel on the right-hand side of our screen there. In terms of investment objectives, Mabatu, what stood out for us here with this result was the question wanted to understand how the respondents balanced that spectrum that you talked about earlier, the risk-return impact question, and how do folks view the prioritization of those tensions in their portfolios. But what is interesting about this result is that we're seeing in the results on the far left, the result that indicates the intention or objective to improve sustainability of my portfolio's investment came out with the highest number of respondents indicating that was a high priority or extremely important. So 76. Then on the other side of that diagram, we see generating high risk adjusted returns came in at 74%. And then in the middle there, our result on diversifying portfolios to manage market volatility came in as probably the lowest of the priorities. Mabatu, your reaction to that, seeing that folks are saying that our objective really is to ensure sustainability, and then yes, sure, we need to get risk-adjusted returns while we do that, but it seems almost neck on neck in that result. Mabatu, your views, please.
Yeah, that's quite interesting. But I think in terms of sustainability, I think we are personally beginning to feel the impact of not focusing on sustainability. So it makes sense that everybody is focusing on this. I mean, I think Heather has just laid the groundwork on what that is, the 30.1% unemployment rate and the socioeconomic impact of all of these things. We are feeling them as a society. And also, I think there's beginning to be a realization. If I go back to the question around why there are people who think sustainability is not a thing for them, it is because there used to be a view that these things are government issues. You know, let government sort out this, let government sort out employment, let government build schools, etc. But I think there's beginning to be a realization that there's a symbiotic relationship between how well the economy is doing from a social point of view, from an economic growth point of view, and how well we are doing as pension funds. After all, I mean, most of our funds need to be invested in South Africa. Having said that, of course, as trustees, we are also very keen to have high risk adjusted returns. It's something that we would like to achieve, given our objectives of making sure that our members retire with have a meaningful retirement. In terms of diversification, you said diversification came out low. That's quite interesting, but
yeah. So, well, this result here is simply talking about balancing the tensions between sustainability and financial returns, not the detail around specific elements of it.
Okay, so I honestly think, and Heather touched on it, and I honestly think part of our issue is lack of understanding on how that whole sustainability investment strategies work. Because I think it goes back to what was said earlier, that people assume that when you pay focus on that, it means you have to let go of the returns that you want. I'm a firm believer that as a fiduciary on a fund, you need to do impact, but you need to do impact and do sustainability in a way that still allows you to meet your objectives, which is growing your members' assets. I have yet to see, and I believe the examples that have been shown, that you can, if you do impact in some instances, it means you have to let go of returns to some degree. There are so many opportunities in South Africa where you can do both. So for me, I still think there is a gap in terms of understanding how to diversify our portfolios, how to introduce and make sustainability part of our integrated IPS. I think there is genuinely a lack of knowledge around the real risks and how to manage them on sustainable investment strategies. Heather spoke about that a lot. And I think that is a significant reason why people are creating a bigger tension than there really is around sustainability and high risk adjusted returns, because they haven't done the real homework to really understand the specific risks of the areas that they want to invest in. Because sometimes, and actually very often, they're not as high as they think they are, but because they don't understand, they assume that you are being irresponsible.
Thank you, Mabatu. Malcolm, I think you have a direct response to this question and potentially something that Mabatu has mentioned. I want to just do a time check. We are at the top of the hour, so we'll let Malcolm share his views with us, and then I'll come back to each of the panelists to give us some final thoughts, and then we will end today's discussion. So Malcolm, over to you.
Thanks, Grant. Yeah, I was just responding. I'm enjoying this conversation. I'm sorry it has to end, but just in response, firstly, those results are interesting, but again, I don't think that sustainability and achieving high risk adjusted returns are mutually exclusive at all. In fact, I mean, obviously here your definition of sustainability is important. So to the extent that it includes like ESG screening or rather ESG incorporation into your listed investment portfolio or engagement for that matter, surely that should enhance return. But to the extent that it's impact investment and you're making direct impact with some investments, very often those investments come with either reduced liquidity or reduced liquidity, but there's a premium that's attached to reduced liquidity, which you can actually take advantage of, and that should enhance returns. And there may also be, the other thing is credit quality the perception of credit quality may be lower, in which case you can get a higher yield as a result of that. So in both cases, the fact that it's impact means that you should get a higher return for it, and you should benefit. And actually, often the perceived risk are not as great as the actual risk. And the second point I want to make there is, the other donut there is about volatility. Is interestingly for those impact investments, to the extent that they're not listed, their prices stay more constant. Now, you could say that's a false price because they should be repriced according to listed valuation metrics. But I mean, this crisis we just went through is a classic example. We've got lots of our clients that are invested in impact products and many unlisted and alternative products. And they actually benefited enormously through the crisis because their market values weren't as volatile. Now, and that's an important signal, both it's important for all funds, but in DC funds, where you have members who panic when fund values go down and they want to pull out, actually having a more consistent value in your fund is a preservation attraction for members, because they don't see their values going down as much as perhaps they would in other areas. And they should be long-term investors anyway, so they shouldn't be pulling out. So I think that's actually a benefit as well, is the low volatility that you could experience by investing in.
Thank you, Malcolm. I'll allow you to gather your thoughts as you think about your closing remarks for us. But let me turn back to our panel. And it will go in the same order as the introductions happened. Malcolm, will double back to you. Thank you. Let's start with Heather, please. Some final thoughts as we wrap up the discussion today.
Well, firstly, thank you to everyone. It really has been a very engaging, thought-provoking panel. I think just something to add, perhaps, is that, for me, impact investing is really about investing in the real economy and directly into debt, equity, property that is largely unlisted, but it's also a way to forge or to help to forge a more inclusive growth path. Having said that, and I really hope that this report is useful in terms of stimulating thinking and, more importantly, action in terms of directing flows and mandates into this space. And I say that because although the survey is certainly encouraging, as we've said, the actual numbers on the ground tell a little bit of a different story. So we're coming off a low base. South Africa has the 9th or 8th or 9th largest pension fund in the world in dollar terms. And a tiny fraction of that is actually dedicated to impact investing strategies. So you can see that as, glass half full or glass half empty. I prefer to see it as glass half full. And hope that we really do see a ramping up of investment mandates into this very important area of impact investing. But thank you. Thank you,
Heather. Let me ask Jolly to give us some final thoughts and reflection on the discussion today.
I think my final thoughts are just around that impact investment. When you really are prepared to engage with it, it has so many benefits. If you look at the financial crisis that happened, the trigger for that was investing in instruments and versus investing in the real economy. And as Africans, I would say more than anyone else, we should be sold into investing in the real economy simply because of the impact that it has on us personally, the impact that it has on our children, and the impact that it has on our futures. And if I can touch on one thing that Heather said, I really like what you said about misplaced risk perception. For institutional investors, there's a serious misplaced risk perception around impact investment. Myself and Mabatho served on a board as well that used a very small percentage of those monies to invest in an investment that gave us a 9% ungeared return in the first 6 months. Did it impact our members? Hugely. It actually ensured that their health was better. Did it impact the employers that were involved? Hugely, because their cargo was safer. Did it impact the economy positively? Yes, it did. Did it create jobs? Yes, it did. So it ticked so many boxes. And that was evidence to me that a fund of that size, which was relatively small, could have such a big impact on their membership base. If they could do it, then through creative thinking, like what Heather was saying, just that creative engagement with the problems that we have, we can solve it like the way we would solve a business problem. Business, after all, is the meeting of a demand or a service where there's an inefficiency. We just meet that demand. I think that we are overthinking impact investment, and we're not simplifying it and looking at it from a business perspective. It just simply makes business sense for us to be in it.
Jolie, thank you very much for those thoughts. Mabatu, over to you, please.
Thanks, Grant. So really, in many ways, I want to echo what's already been said. I'll never forget a conversation I had with a representative from the African Development Bank. They were so shocked at how South African pension funds were investing in the context of an economy that has two worlds in one, first world and third world, that so little of pension funds assets were being invested in the real economy. And there's a historical context to it. I think everybody knows we used to get really good double-digit returns from the listed markets. But I think we've got to understand that investing in impact investing in sustainability, it's not a kumbaya strategy. I think that there are components of the market that think we're talking about kumbaya. We're not. We are talking about building an economy that is robust, that can sustain itself, because there is actually a direct correlation between how well we do as pension funds and the context within which we operate. So if we operate in an economy that's not doing well, it impacts directly on our returns and therefore our ability to meet our obligations to members. That's the first. And then the second thing, there are so many great opportunities, and I think Jolie touched on that, great opportunities in the impact investing space that will still give you double-digit returns, and not necessarily with the sort of risk that people perceive to be in the spaces. What excites me and potentially will move more flows into this area is that you're beginning to see a lot of financial engineering, engineer solutions where, and I know one of Heather's funds that we've invested in as a National Treasury, a SASME fund, where we have a first loss mechanism that enables funders to move in and reduces risk for those funders. It's the same thing that has happened with another fund that is a multi-manager fund that invests in private equity. But my point is there are many, many good opportunities that are not in the listed space. I think what trustees need to be doing is ensuring that they genuinely understand this spectrum. They understand the risks in areas that they want to invest in, and not just have this wild perception of risk, which is completely out of line with the actual risks of investing in some of these funds, and potentially letting go of good returns that would enhance our investment strategy, including reducing volatility on their funds. Thanks for me.
Mabatu, thank you. Very insightful. Malcolm, let me turn to you for some final thoughts now, please. Thank you, Mabatu.
I think that I'd really want to encourage pension funds that are reading this report or participating today to think hard about why that fund exists in the first place, and about then not only the money but the environment into which members retire. And I think that once you get in touch with the fact that the real economy is, we've discussed many times here, is that actually really matters, that you be prepared to push the boats out. And to the point Mbatha was making about the listed market and its double-digit returns, it's also true to say that in the last 5 to 10 years, we've had a slew of bad actors in the listed and formal investment space in South Africa that have actually cost pension funds a tremendous amount of money. That should be the reason to actually be looking further afield and finding the right investments to give you additional returns and at the same time do the right thing for the country and what really matters to the members.
Malcolm, thank you. Thank you very much for that insight. And finally, our final panelist, Stuart, over to you for some final thoughts and reflections, please.
Thanks, Grant. This has gone so quickly. There's so many meaty issues to tackle around this.
Yes.
I feel we're talking a lot longer. I think just to endorse Jari's point that to some extent it's about business as usual, and it's about aligning financial markets with what we as a society want our society to look like. And our society is a group of consumers and investors that want to see investment markets work towards their personal objectives. And I think Malcolm's point about conceptualizing what a pension fund is ultimately for is spot on. And as we do that, we start to direct the financial markets and mechanisms in order to get the outcomes that consumers ultimately want. Because it's about, financial markets are just a tool, right? They're just a tool to deliver certain things that we want. And I think the outstanding thing that this debate is doing is getting us to question how we make this tool work better for us. And it can be decisions that we make as investors, but also I think decisions that policymakers make, because they ultimately should be concerned about the public interest, and it's through policy tools that you can shape financial markets to deliver certain outcomes. So we mustn't forget that the policy discussion also has to happen while we as a financial industry work with our clients and work with investment markets and mechanisms to achieve the ultimate goals here, which is to deliver a better life for our society and members of a society. So thanks very much for a super interesting discussion. I hope we can continue it in other forums.
Thank you, Stuart, and thanks for joining us today. Folks, we've come to the end of our discussion, but before I say goodbye, I'd like to acknowledge just a few comments that we picked up in the chat for our panel discussion today. One input from Nicole Martins says that soon there is going to be a report exactly on this debate of financial duty that is being released by the UN's PRI, the Principles for Responsible Investments. And the report, or a legal framework at least, is available already on the UN PRI website. So thank you, Nicole, for that input. And then a message from Tanya van Lille, who is the CEO at SAFCA. Thank you very much. Very interesting panel discussion and very interesting findings and very relevant to South Africa. So folks, thank you very much for joining us today. And the slide there indicates that the report is available on our website, intellidex.co.za/investing for impact. And with that, it leaves me one last thing to do, which is to thank our panelists very sincerely and with huge amounts of gratitude for participating in our conversation today and for all of your contributions to making this report come to life. And in particular, of course, to Ashburton Investments for funding this research. We are incredibly grateful, and I think it's made a meaningful contribution to our understanding of the debates and understanding of the challenges, and more importantly, understanding what opportunities are available in the space of investing for impact. And with that, I'll say goodbye from Washington, DC. Thank you all for joining us.
Thank you.
Thank you, everyone.
Thank you very much.
Thank you.
Thank you.
Bye-bye then.